Okay, so good morning and welcome to our session on investment readiness in collaboration with EY. For those who don't know me, I'm Alicia from One Nucleus. I'm the Business Development Manager, and I'm delighted to welcome those on our call this morning who've joined us. I'm also delighted to be joined by Greg Costello and Rich Gould from EY. So just to give you a little bit of a background to both Greg and Rich. So they are with EY's law team and have extensive experience within this department, some focusing around the EY fast growth platform. And today it's going to be mainly Greg, but with some vital insights from Rich as well around how to prepare for transactions. And I think the aim is that the session is going to be directed towards startup as well as growing companies. And I'm aware we have a selection of companies on the line, perhaps and individuals at different stages. So I just wanted to emphasize there that there is sort of a broad spectrum there of relevance. So Greg is a senior manager in EY Law's transaction team and performs some of his role is around relationship management for EY's fast growth platform. And I know, Greg, you'll probably provide a little bit more background to that in as part of the presentation.
Yeah, no, absolutely.
Perfect. And then we also have Rich. So he's global head of the tech sector for EY Law's team and has a very broad range of experience within that sector in terms of fintech, ad tech, digital media, e-health, and enterprise software, and has a speciality in international M&A and fundraising transactions. So thank you both for joining us on the call this morning and for your time as well to deliver this webinar. We are a fairly small group, so actually that means we can keep it as an interactive session. So it's just discussing with Greg before the start. Please feel free to use the chat box, but also there is a raise hand function on the bottom toolbar where it has reactions, and I'll try and keep an eye on that. So if you wanted to even raise a question during the presentation, we're happy for you to do that. But otherwise, there'll be some time after Greg has and Rich have delivered the presentation to have maybe more of an open discussion. And also, like previous sessions, if perhaps there's a question you have that you maybe want to take offline, then that's absolutely fine. And I'm more than happy to join the dots after the webinar so that you can maybe have an offline conversation with the team online today. So with that, I will hand over now to Greg and Rich. If you'd like to do some further introductions, brilliant. If not, and you'd like to go straight into the presentation, then that's also great. So over to you guys. Thank you.
Thanks very much, Alicia, and everyone on the line as well for joining. Great to be speaking with you all, and we hope that you'll find the session to be a useful one. I can kick off with a bit of further introduction on myself, and then Rich, perhaps you can give a bit of intro on you, and then we can dive into the topics. So as Alicia said, I'm Greg Costello. I'm a senior manager in the EY law team. I perform a bit of a dual role, partially kind of advising clients in the classic sense on corporate transactions, most commonly on venture capital, private equity, and private M&A transactions for a variety of different clients, ranging from sort of founder entrepreneurs, investee companies, more established corporates and investors. And the other part of my role, as Alicia mentioned, is acting as a relationship manager on EY's fast growth platform, which is a multidisciplinary service offering targeted at startups and scale-ups to effectively try to make available to the startup and scale-up community the broad service offering that EY can give at a sort of more attractive price point for startups and scale-ups, in the hopes that those companies will kind of become the unicorns of tomorrow, and that we can kind of grow alongside you on and come with you on that journey. Rich, do you want to give a bit of an intro and then we can dive in?
Yeah, well, I guess the good morning, everybody. The only other thing I'd say is we'll sort of stray outside of the bounds of just law today. We will talk about not just the forms of different investment you can get, but also a full range of things that companies need to think about as they go on their fundraising journey, whether you're a tech company, a life sciences company, or otherwise, really. And towards the end of the webinar, we'll talk around the methodology that we use on our fast growth platform for helping companies make sure they both get prepared across all of the areas of the business and then stay prepared as well.
Great, thanks, Rich. Yeah, as I said, a few different items on the agenda. We'll kick off by looking at sort of three specific funding types that we commonly see in our day-to-day. We'll then focus in on some of the key terms involved in those, kind of legal and non-legal. We'll then comment on some of the more common sort of red flag areas that we encounter when we're carrying out legal due diligence during fundraising transactions. And then, as Rich says, we'll speak a bit about how we work with clients to prepare for and execute fundraising transactions before we have the sort of Q&A and experience sharing part of the session. As Alicia mentioned, do feel free to use the raise your hand function, or if you want, just interrupt me if you have a question that you'd like to ask as we work through the session. So starting off with funding type comparison, as I mentioned, it's a bit of a busy slide, but I'll talk you through the different points that we have here. I mean, obviously, the different types of funding that startups and scale-ups have potential access to goes much further than these three that we have on the slide here. Obviously, grants and other forms of funding, more traditional debt finance is available for startups and scale-ups to access as well, but we've focused on these three on the basis that they're the ones that we come across most often in our day-to-day, and the ones that we see most commonly sort of used by startups and scale-ups outside of the sort of grant setting in this sector. So starting then with equity investment, then as it kind of says on the tin, really just issuing shares in the company in exchange for investment. So I guess the fact that it's not a debt funding means that you don't require to constantly be thinking about the next repayment of the debt or the interest thereon. So I guess kind of gives the decision makers in the investee company a bit more flexibility to think a bit more long term about how they want to run the business and not constantly kind of have the stress looming over them of the next repayment that might be due. And another point that we flagged here in relation to equity investment is that, of course, because your investor has a vested interest in the company by virtue of the shareholding that they'll acquire, they obviously want to see that business succeed and to crystallize a return on their investment, which means that they're a lot more likely to invest time in the business, be that by providing sort of strategic guidance or support, or providing access to connections, which might help to accelerate the growth of that business. Of course, the downside of giving up equity in your business is that in turn you are giving up some control. A lot of the time, equity investments are very much sort of, certainly in this space, are minority investments. So you don't see investors taking a controlling interest in the business, but they will often take sort of more than your 25%, which kind of gives them enough to block certain actions that the company might wish to carry out. And in addition, they might also seek to put in place contractual controls and vetoes, meaning that you would have to go to your investor to ask for permission before you can do certain things, which then kind of comes on to the next point there around the documentation involved, and the complexity of the process. Of the three funding types that we've listed here, equity investment is the sort of at the longer in terms of process time, because it does have the most documentation involved, and that documentation does tend to have the most elements of complexity in it, which we'll come to in more detail on the next slide. And as a result, yeah, as I say, that means that the process can be a longer one than with your convertible loan notes or advance subscription. And certainly for early stage businesses where it might be quite a small team, the founder might be wearing a number of different hats on each day, and it can be quite a big distraction from the day-to-day running of the business if you're also having to try and run a funding process alongside that. So that's another thing that has to be taken into account. Coming next on to convertible loan notes, a slightly different funding type. In effect, it's basically a loan that's repayable at a defined future date, but which may instead convert into shares in the company. Generally, it only tends to require a couple of documents, so your sort of loan note instrument, which kind of constitutes the loan notes, and then a subscription document where the investor would actually subscribe for those loan notes. And that tends to mean that you've got sort of shorter process time. I mean, an equity investment can take anything from, sort of 8 weeks to sort of 4 months, depending on the complexity of the transaction. Whereas for convertible loan notes, you're more commonly looking at sort of period of sort of 2 to 4 weeks, which obviously can lead to kind of more time that the management team have to spend on running the day-to-day business. One of the sort of pros to convertible loan notes is that you have no sort of upfront dilution of the existing shareholdings. So if control is a key driver for the funding type that you choose, then that could be something that comes into play. But obviously down the line, if there is a conversion of the loan notes, then there will be a dilution at that stage. So that's something to bear in mind. But I guess because there is less documentation involved with convertible loan notes, there tends to be less strings attached to the investment than what you see with an equity investment. So you don't, for example, see as much in the way of warranties and representations that the founder or the company might have to grant to the investor. There's less in the way of the controls that I mentioned before, or the matters that you might need to go to the investor for consent on. So largely you kind of retain that sort of autonomy to continue running the day-to-day business in the way that you see fit largely. There are still some complex items within the documentation, which we'll come on to a little later, but obviously it is less in volume. And the thing to flag, I guess, on a couple of things to flag on the downside with convertible loan notes is that depending on the commercials that you agree around the future conversion of those loan notes, that they can produce quite harsh results in terms of the conversion if ultimately the business doesn't perform in the way that you've anticipated or that you hope. And the final point there is just around SEIS and EIS relief, and the fact that convertible loan notes don't qualify for that, which makes them kind of less of a attractive investment type for individuals, certainly. And then the final one on the slide here is advanced subscriptions. Very similar to the sort of US concept of a SAFE. I'm not sure if anyone on the call is sort of heard of those, but SAFE basically is a simple agreement for future equity. Effectively, what an advanced subscription is just putting in cash in exchange for an issue of shares, but at a later date, so not at the time of the investment, unlike an equity investment. And conceptually, advanced subscriptions are very similar to convertible loan notes, but they're not. The key difference being that they're not debt, so they don't have an interest rate attached to them, and they don't have an ultimate repayment requirement, given that they'll be if you like, the shares will just be issued at a later date, and that will satisfy the investment that's been put in. Coming then to the sort of process time and the documentation involved in advanced subscriptions, this is probably less burdensome again than convertible loan notes, as you can basically complete an advanced subscription with a single agreement. So again, that should make for an even shorter process. Sometimes sort of 2 to 3 weeks is what we tend to see on advanced subscriptions. Again, with advanced subscriptions, there's no upfront dilution, and there's very limited contractual provisions around things like warranties, as I mentioned before, and less contractual obstruction to the day-to-day running of the business. So again, much less in the way of needing to go to your investor to ask for permission before you do things, and retaining that level of autonomy, certainly in the short term. But as with convertible loan notes, there is the possibility for slightly harsh results when the shares are issued, depending on the commercials that are agreed around the basis upon which the shares will be issued. So things are like the discount that will be applied to the price for the shares that are eventually issued, and any valuation caps that are included for that purpose as well, both of which we come to in more detail later in the session as well. Before I flick on to kind of getting into some of the more specific terms around these three types of investment, any questions at this point? Or Rich, was there anything that you wanted to kind of add to colour any of those points?
No, other than to say, I guess with the increased number of US investors, there is, and always has been to a degree, a drift towards the US approach, and we are seeing in many situations companies having a bit more power in the US. I guess there are slightly different dynamics than there have been in Europe. We've seen in Europe for a long time investors really having the upper hand, and in the US for some time the market's been so hot for VC investment that the best companies have the upper hand, and therefore have been able to get more streamlined terms. Deals have been happening faster, and we are seeing some of those dynamics beginning to play out now. Sometimes it can feel a bit like water torture when you're raising money in the early days, but as companies begin to scale up, things do begin to get easier, and we're seeing many more deals happening quite rapidly and much more favourably for companies as well. Hopefully good news for everybody on this call.
Thanks, Rich. And I don't know if, I suppose we'll reach the Q&A and the experience sharing later in the session, but if anyone has any questions or kind of experiences of any of these three funding types that they want to share at the moment, do just shout, please. Okay, so moving on then to just some of the key terms that we tend to see or that come up in every equity investment. First and foremost, we'll come on to convertible loan notes and advanced subscriptions. As Rich mentioned at the start of the call, it's not just legal points that whilst Rich and I are both kind of lawyers by training and background, we very much kind of get into sort of the non-legal topics as well when we're advising on these transactions. And a couple of the points here on this slide, especially the first couple, are kind of very much kind of step out of that legal landscape. So the first two bullet points here being the sort of pre-money versus post-money valuation, and undiluted versus fully diluted share capital. These two very much kind of impact upon ultimately what stake the investor will have in your company. So basically, I mean, as it sounds, your pre-money valuation is basically the value of the company before the investment's made, and then post-money is your post-investment valuation. So if, for example, an investor says, we're going to put in £5 million on a valuation of 20 million for the company, I guess what we'd be saying is that it's important to flesh out what they mean by that valuation. Are they talking about the pre-money, or are they talking about the post-money? Because if it's the wrong one, then it can have quite differing results depending on which one they are speaking about. So I guess it's just often the way that these transactions work is that there'll be a term sheet or a heads of terms, once discussions have gotten to a more formal stage between the parties. And so at that stage, it's certainly important to flesh out concepts like this and make sure that when they put a value on the company, are they speaking about the pre-money or the post-money valuation? And the second point related to that same point is around undiluted versus fully diluted share capital, which is more of a legal concept, but again, very much kind of plays into the commercials of what the investor will ultimately hold once they invest and receive their shares. So if you're speaking about the undiluted share capital of a company, it's basically the shares that are in issue at the time, so that have been issued by the company at that given time, whereas your fully diluted share capital also takes into account things like share options or other rights that have been granted by the company to subscribe for shares at a future time. So it could be share options, it could be share warrants, these sorts of things. And again, if an investor says that they're going to invest for a set percentage of the company, it's about needing to flesh out what they mean by that percentage. Is it a percentage of the current the issued share capital of the company post investment, or is it the fully diluted share capital? Because again, it can have quite differing results and lead to some surprises. The way that we've found in practice is best to sort of bottom out these points really is to either append to your term sheet or your heads of terms, or to at least agree at an early stage between the parties a cap table. So basically a share cap table setting out both the existing shareholdings in the company and what will be the post-investment shareholdings. And that cap table making it clear the number of shares that the investor will hold, so that it can then be kind of extrapolated what their percentage shareholding will be, and the existing shareholders and the management team can then clearly see what percentage stake that investor will hold, and then factor that into decision making around the deal and the commercials of the deal specifically. So that covers the first couple of points there. The next point, quite often, certainly in the sort of life sciences sector, what we tend to see is that there are quite often investments which are made in tranches, so in sort of separate installments. And linked to that, what we often see is that those installments will be conditional upon certain conditions or milestones being reached or satisfied or waived by the investor. And I think that the main point that we wanted to make around this one really was that clarity is key, and having, so for milestones, having clear and sort of easily measured milestones or conditions is very much what you want from an investee company side of things, and not things that are more sort of vague and open to interpretation. For example, we had one recently where the milestone was basically the completion of a toxicology study, such that a phase 1 trial could then commence thereafter. And that was, I mean, we were acting for the investor in that scenario, and there were other milestones and conditions, but I think the key thing that we would stress is that from an investee company standpoint, the best thing you can do is have milestones which are very easy to measure, and so aren't open to interpretation, and to try to stay away from things like wording like to the satisfaction of the investor, or in the opinion of the investor, where things can be taken by the investor and interpreted. And also to try, if you can, it's not possible with certain investors depending on how they're set up, but you very much want to try to avoid investment committee approval for the second tranche, because that in effect basically gives them a bit of a get out if they want one at that stage, and it kind of reduces the second tranche of the investment to a bit of an option at that stage. So I think trying to keep the milestones and conditions as clear and measurable as possible, and staying away from that vague open to interpretation side of things makes it more likely that the second tranche will come in more easily, and there'll be less scope for debate on that. The other item mentioned in this bullet point was just commercial side agreements that can often come alongside prospective investors' proposals to invest. Rich, I don't know if you wanted to touch on this one, or I can take this one if you like.
Why don't you go ahead, Greg?
Sure. So I think that the key point that we really wanted to make around these commercial side agreements is that, especially if you have an investor who's sort of, they're not an institution, they're more a trade player in the sector that you operate within, it's quite common for them to seek to have some form of commercial agreement on the side, or to, in some cases, even have an agreement which gives them an option, for example, to purchase the company or to purchase the company's IP. And I think the main point that we wanted to make around this one at this stage was that it's important that you bottom out any desire for these types of things early in the day, so that you know the whole deal, and it's not a case of things like this coming up late in the day when you would have no interest in such an arrangement, and you've already spent time and expense getting to that point in proceedings. And also the other point we would flag on this is just to ensure that you have lawyers engaged who can advise not only on the corporate investment side of things, but also on any commercial agreements which are more, well, commercial in nature and less on the corporate side. And then the final point around equity investments that we want to kind of drill down into in a bit more detail was just around liquidation preferences. To be honest, we could probably do a session on these alone, and it can be quite a dry topic, so I'll canter through this one as quickly as I can. But essentially, liquidation preferences, they're one of the most important provisions that come up in equity investment transactions, as they will ultimately determine what return the investor receives, and therefore what the other shareholders will receive on an exit event or a liquidation. So that might be a share sale, an asset sale, or a more standard liquidation of the company. And if you were to take any one of those exit scenarios and have the proceeds just divided without any liquidation preference, that would essentially mean that they would just be distributed to the shareholders in accordance with what their relative shareholdings are, which could, from the investor standpoint, mean that they make a loss if, for example, an investor puts in, let's say, £5 million for 20% of the company, and then the company then sells for 10 million, then that investor is going to make a loss on their investment. So the purpose of a liquidation preference for an investor standpoint is to effectively protect against downside risk and potential downside scenarios. So it effectively allows the investor to get back what they invested, and in some cases a multiple of that, as priority over the other shareholders. There are generally three sort of main types of liquidation preferences: non-participating preferences, full participating preferences, and capped participating preferences. So I'll speak about non-participating preferences, first being the one that we see most commonly. That basically gives the investor the right to receive their money back in priority to any other shareholders, but then once they've received that money back, they then don't participate any further in the proceeds from the exit event. Whereas with a full participating preference, that would allow the investor not only to get their money back, but then also to participate alongside the others pro rata as well, in accordance with their shareholding. And then with your capped participating preference, that basically it is a bit of a hybrid in the sense that it would allow them to recover their investment or a multiple thereof, and then allow them to participate also alongside the other shareholders, but only up to a certain maximum level, which is often sort of described as a multiple of their investment amount. So yeah, very much kind of important to keep these different types of preferences in mind, and to seek advice when it comes to items like these, and also to think about the fact that these sorts of preferences can also kind of lead to what we would call sort of either dead zones or zones of misalignment between the investor and the rest of the shareholders. Because if you think about a scenario where an investor has a non-participating preference that allows them to get their money back, but not really anything more than that, then basically that investor, unless the value of the proceeds that are going to be received on the exit are so high that the investor would effectively forfeit their preference and elect to simply participate alongside the other shareholders, then that investor isn't really going to have much of an interest in trying to up the purchase price, because until they reach the point where they're going to receive more, just simply participating alongside the other shareholders than they would and just using their preference, then they don't really care much about what's in between. Whereas for the other shareholders, that obviously is of much importance to them, because they will still participate in the residue of what's left after the investor gets their preference. So that can very much lead to sort of misalignment between investors and the other shareholders. I'll pause for a second there before moving on to some of the terms around convertible loan notes and advanced subscriptions, if there are any questions or comments anyone wants to add at this point.
Greg, there is a question in the chat box.
Okay.
And also do invite attendees to on mute if you'd like also. Dino, to ask your question, that's absolutely fine.
So I'll pick up the question. Conflicts are fairly rife, and you see it probably a lot more with life sciences companies than you do with tech companies. But you can see it in both. Greg and I were involved in the sale of a fintech business called Algomi that we sold about a year ago now, and they'd raised multiple rounds of both finance from investors, a number of high-profile US and European investors, as well as strategics. And what happened there was that every time a round came in from a strategic, the investor would want a representative on the board, and then that representative was normally involved in the operation of the sidecar agreement. So there'd be some sort of technology being developed. And these things become a distraction sometimes they become super useful, but actually you do need mechanisms in place to make sure that if there is either too much distraction or an actual specific conflict that's created, you do need the ability to water down some of the investors' rights. Sometimes you need the ability to take them out of decision making altogether. And you have to think through all of that when you put the deal together in the first place, which is one of the reasons why those sorts of transactions are more complex, because you've got to think about the equity rights coming in. You've got to think about the due diligence process. Are you giving away the crown jewels? Are you making sure that actually there is a genuine deal here? It's not just somebody coming in and just having a look for their own purposes. And then from a governance perspective, you do need checks and balances in place that go all the way through the life cycle of the company through to exit, because you can see some of those conflicts really coming into play when you then come to either take a company through to IPO or the exit event, because typically these strategic investors aren't investing to then sell to a competitor or somebody that's just non-strategic for them, that they've invested with one thesis, and that M&A event might just completely blow up that thesis altogether. So it's really important that you put those checks and balances in place. And given the fact that you've got a David and Goliath type situation, often when you're negotiating, you've just got to fight your own corner and make sure that even if the deal takes longer to put together, which these strategic investments often do take longer to put together, you're better off taking your time and being thoughtful. Marry at haste and repent in leisure, as my mother would say.
Thanks, Rich. So just moving on then to a few different points around convertible loan notes and advance subscriptions. As mentioned before, the two are conceptually pretty similar in that they both involve an investment, a form of investment being made with shares being issued at a later date. And the first point on the list here is just around triggers for conversion in the case of convertible loan notes, so the conversion of the loan and the interest, and then share issue in the case of advance subscriptions. And so the triggers for conversion and share issue, they're items that are very much open for negotiation between the parties. But generally, the ones that we see tend to include things like future equity fundraisers, or an exit in the future, or also just defined dates in the future. So basically, if there is one of these events in the future, that would then trigger a potential conversion or share issue. One of the points that we would flag around the triggers and want to sort of pay proper attention to is around what degree of control the investor has around whether or not the conversion takes place or the shares are issued, or whether it happens automatically. So basically, if there is a fundraise which triggers conversion or a share issue, does that happen automatically, or does it only happen if the investor elects that it will do so? And this is where you can sometimes get into things like definitions of a qualified financing and a non-qualified financing, which tends to be defined by reference to how much has been invested. And often what we see is that where it is a qualified financing, then the conversion or the share issue is automatic, but where it's non-qualifying, then it's only really at the election of the investor. So I guess 2 points to kind of pay attention to there. One around the degree to which the conversion or the issue is automatic, and then secondly, just around the specific definition around what the event is. So if it's qualified financing, for example, what level of investment would constitute a qualifying financing, for example. And next, coming to discount and valuation cap, how these concepts tend to factor into things is around calculating what number of shares will actually be issued on conversion of the loan or on the issue of the shares under the advance subscription. And essentially what happens is that the number of shares is calculated by dividing the amount of the loan in the case of your convertible loan notes, or the advanced subscription amount that's been put in, by a defined conversion price. And what that conversion price actually is tends to depend, it's set out in the documentation, is there for negotiation and agreement, but it tends to depend on what the event is that triggers the conversion. So if we take the example of a fundraise, the starting point for the conversion price would tend to be the price that was paid by the investor in that future fundraise. And where the discount then tends to come into play is the discount is then applied to that price. So you would effectively, let's say, if an investor is going to come in at a future fundraise at a price per share of £2, and then you've got a discount of 20% agreed in your document, then the price that you would use to calculate how many shares that existing investor would receive would be £1.60. So applying the 20% discount to your £2 share price. And then added to that is the concept of valuation cap. So if a valuation cap has been agreed, and basically what that means is that at the time of conversion or the share issue, you would divide that valuation cap by the share capital of the company at the time. And if that produces a share price which is lower than the price that you calculated before using your discount and the price being paid in the round, then that lower price would form your conversion price, and therefore the basis upon which you would calculate the number of shares. So pretty technical legal concepts, but very much kind of traversing also with the commercial side of things on these documents. And both, I would say that we always see one of two out of the discount and valuation cap in the documents. We sometimes see both. Obviously, from an investor standpoint, if they can get both, then it's all the better, because your discount effectively means that whatever the round price is, you will always be using a lower share price to calculate what your price is for the purposes of conversion or the issue of the shares. And then having the valuation cap in place protects the investor in the sense that if you come in at a certain valuation at the time, and then the valuation of the company proceeds to skyrocket straight afterwards, then you still have the ability to have a share price which will give you a meaningful stake when you come to convert or to have the shares issued. So from the company's perspective, however, it's important to pay proper attention to especially the commercials of the discount and the valuation cap, because they can, not only can they produce quite harsh results of dilution for existing shareholders if, for example, you had a down round in the future where the things haven't gone quite as planned, and new investment is required simply to save the business, and then you also have loan notes converting or an advanced subscription crystallizing into shares. It can really have significant impact in terms of dilution. But the other side of things is that if you give an investor two friendly terms in convertible loan notes or an advanced subscription, a prospective incoming investor might look at those terms and think, I just can't stomach the fact that that investor is going to have such a big slice of the pie for what they invested at the time, and that could actually in itself just put off prospective investors. So it's important to kind of have that eye to the future as well when thinking about those. So that kind of takes us to the end of the specific points that we wanted to raise around equity investments and convertible loan notes and advanced subscriptions. Obviously, there's a lot more to those, and we could probably do a session on any one of those, to be honest. So very much a canter through. But if there are any questions, do feel free to share, or we can raise them in the Q&A. I think we might have.
We've just got one come in from Martin. Yeah. Martin, did you want to unmute to ask the question, or not?
Oh. Yeah, I've seen this happen several times where it might be great for the small company to have, say, a top 10 pharma company as an investor. But if you're dealing with the corporate venturing arm, then the way that they will view your company as a potential financial return could be very, very different if in the future you're then trying to negotiate a licensing deal with the same company, because you'll be dealing with a completely different function, and that the business development people within that large pharma company will be looking at the return on a project, not the return on your company as a whole. And I've seen occasions where it's caused difficulty by the business development function trying to get something done, which is then being blocked by the corporate venturing arm.
Yeah, it's a good point, Martin. And actually, so I've seen exactly that as well. And I think partly the challenge is they're all different. So particularly the pharma companies, many of them, almost all of them, have venture arms, but many of them operate in different ways. Some of them operate almost entirely independently. Some of them operate very much hand in glove with their other teams across the business units. But you're right, that is a significant problem sometimes. I find it if possible, it's best to try and tie these things together. As I said earlier, it does mean you're taking longer, but if you're trying to get a license and get an equity investment happening at the same time, at least then you can identify potential conflicts, different teams, the dynamics, and then try to use as much leverage as you can to make sure that nothing's missed in either pocket. You often do see, we'll do the equity investment and then we'll agree the licensing deal, but then things change, people change, strategy changes, or indeed you bump into the issue that you've articulated, where people just haven't sort of fully thought it through, and how they think about life can be quite different in different pockets of these large organizations. It's a very good point.
Yeah, thanks, Martin. It's a great question. Just conscious of time and wanting to have enough time at the end for some Q&A and discussion as well. The next slide's just around some common red flag areas that we encountered during legal due diligence in these types of transactions. Don't propose to spend long on these at all given time, but the first of these centers around intellectual property, which is obviously absolutely critical to the types of businesses that we tend to work with. And the specific points that come up quite a lot when we are carrying out diligence is either that a company has used a contractor to assist in developing part of its product, or that the employment contracts of the contracts of the employees are not quite as watertight as you would want them to be in the sense of intellectual property. So with contractors, sometimes what we find is that no terms were entered into at all with that contractor, or that the terms aren't specific around who holds any intellectual property and what's developed. And that can obviously lead to some pretty difficult discussions with a prospective investor, given the importance of intellectual property to businesses in the tech sector generally. And so it can either lead to having the investor basically saying, we need you to go back to that contractor and seek some sort of either confirmatory assignment of IP, or essentially get comfort from them that the IP does in fact sit within the investee company. Or it might just spook the investor entirely, and they might just not be willing to proceed on the basis of that risk that's been highlighted. With employment contracts, it's kind of a lesser risk in the sense that there is the assumption if they are developing something in the course of their employment, that IP will sit within the company. But nonetheless, it's important to kind of have provisions within employment contracts that ensure that the IP will sit with the company, including any sort of moral rights or things that may attach to that person as an individual. And that's the kind of things that we see crop up in diligence. And so I guess the best thing on that obviously would be to ensure that the contracts that either that you take advice, or that the contracts that are put in place at the time that they're entered into have got the proper provision made for intellectual property, but otherwise that you kind of have some analysis done before a transaction to make sure that things like this can hopefully be addressed before you're into the meat of a transaction and they might become an issue. So moving on then to statutory registers, a bit more of a legal one, to be honest, but one of the first items that lawyers for an investor will ask to see if they are carrying out legal DD is the statutory registers of the investee company. So it's registers members, directors, charges, that transfers, allotments, that sort of thing. And quite often we see that either the companies don't have statutory registers at all, or that they haven't been properly kept up to date, or that they're not quite right. There are errors in them. And I guess the point that we would make here is that this is probably, I'm sure Rich will agree, one of the items that crops up most often that adds to process time in these transactions, because you either, if there are deficiencies or there just aren't registers in place, then you end up having to have these constituted, or in the worst case, if there's something wrong, you might even have to go to the court to have them rectified, which can take time and isn't really something that you want to be doing during a process that's already very demanding on your time. So I guess the recommendation on that would just be it's even worth the money of having a company secretarial provider maintain registers like these to ensure that you can just ask for them and produce them as and when you need to, and it's a responsibility that kind of sits outside of the management team's hands. And then the next point is around sort of existing agreements that are in place and how they might impact on the transaction that you want to do. So if, for example, you've had some early seed investment and you've got a shareholders agreement in place, or indeed you've entered into an advanced subscription or a convertible loan or something of that nature, something that we'd very much recommend is having a look at those agreements before you go to raise funds again, to ensure that, to the extent that any consents are required under those agreements, or if they might, negatively impact or give someone under those agreements the ability to sort of veto the transaction, that you're communicating with those parties at the right time and not sort of bringing them in at the 11th hour when they might just simply block the deal or demand something unreasonable at that point, given how far you are into the transaction. We've had clients where there have been provisions which effectively give rights of first refusal in relation to transactions and consent rights and things like that, and it's always better to be addressing those items before you're in the meat of discussions with a prospective investor, and be able to say to an investor, okay, we do have these existing agreements, but we're in constant communication with the other parties, and they've already given us comfort that they're going to consent and sign what they need to sign effectively to make sure that the transaction can go ahead. So that would be the recommendation around that one. And then the last one, just quickly around defective share buybacks. This is one that is probably more common in slightly later stage companies. And the classic scenario is you've had someone who was involved in the business near the beginning. They had shares in the company, and then for one reason or another, they decided to move on and do something else. And so the company bought the shares back from that person. And sometimes we've got sort of varying degrees of this, but sometimes it's as simple as the company saying, well, the person handed back their share certificate and we gave them some money, so we bought the shares back. But actually, there's pretty strict requirements around what's necessary to validly buy back shares. For example, there's things like needing to look at the distributable profits of the company and needing to have in place a written agreement, and it's very much a prescriptive process that's required under the Companies Act for a share buyback. So I guess the point that we'd make on this, for earlier stage businesses, it's probably more a point of, if you are in a situation where the company's going to buy back some shares, seek advice, legal advice and accounting advice around that, because the consequences of not doing so correctly can be that the whole buyback was void, and then you have a scenario where you're trying to track down what you thought was a former shareholder to try to ratify something, and there can also be sort of tax consequences that come with that. So not to try and sort of put the fear of death into to people, but it's one of these ones that we see all the time and that can be quite costly, in both in terms of time and money in a transaction. So it's very much one, if you sort of hear share buybacks, it's one very much to kind of seek advice on. So that was that on the common sort of red flag areas. I'm conscious that we're quite tight for time, but Rich, I'll pass on to you to quickly cover how we help startups and scale-ups in this area.
Yeah, thanks, Greg. So while we have got a couple of slides that show the full breadth of what we do, the EY Fast Growth team has got a full service team that helps companies with fundraising, and they provide experience to companies, helping them think through accounting, tax, legal, as well as strategic topics. And our corporate finance team helps later stage companies with a turnkey solution. And we typically work with companies for years, not months, on just a single transaction. If you just flick over to the next slide, given time, we won't go through all of these, but one of the things we encourage our clients to do is work through health check in the early stage of working with us. And you just see a mock-up here of one of those health checks, which looks at strategy and commercial, financial, legal, and over the page are a series of other topics, HR, tax, and so on. And what we do is we try to help, for the earliest stage companies, this is in a very light touch way, help companies think through how ready are they for the transaction from a business plan perspective, all the way through to the nits and grits of the sort of legal topics that you've heard about today. If you flick over, there you are, onto the next slide, you'll see it's a 360-degree view, really. And the last point I'd leave you with is to say that you can't over prepare for these types of transactions. I'd say one of the biggest mistakes we see is that companies just don't get themselves quite fully prepared for the diligence and the distraction that comes along with a transaction. So the more preparation you can do, the faster your diligence process is going to be, the more competitive tension you can keep on investors for as long as possible, and therefore you'll minimize your own distraction. And we'd certainly love to talk to you more about your own fundraising needs if there is the opportunity to do so. With that, I think we'll just ask if there are any questions at this stage, please.
Thank you, Greg and Rich. Yes, to all the attendees, please do feel free to unmute at this stage. It's a brilliant opportunity to speak firsthand to the experts on the line today.
Yeah, we're certainly happy for the slides to be shared with them. You can see the health check methodology at the back of that, and if anybody would like a follow-up conversation, a one-on-one around their own company or companies that they're involved with, then we'd be delighted to do that as well, of course.
Hi, can you hear me? This is John McCafferty. Can you hear me?
Yes.
Hi there. So we just recently set up a company. Myself and Anish is also on this call, and you know, we're kind of underway with functional labs, but we really need to sort of get moving now on a fundraise. And so I'm interested just to try and get a little more layer of detail, and maybe we can follow up with a call as well, but just to understand what we get by working with you guys. So we have a patented technology, we have a small functional lab, we have, you know, 4 or 5 people going, and we're starting to get our story ready. So we knock on the door with you guys, and can you just give me a kind of gain an overall sense of what you offer and what sort of timelines you typically expect from that conversation to, you know, closing a deal? Now, I know that's how long's a piece of string type question, but maybe give me a feel,
sure.
please.
So we don't typically offer corporate finance type services until later stages, later than you are. So the services we offer for startups tend to be much more around helping them get prepared, the sort of topics you've heard about today, making sure that you are as clean as a whistle for diligence processes, whether that's tax, legal or accounting. And often for startups, the issues are really pretty light touch. You've got to make sure that you are going to be capable of raising your deal with a clean corporate structure as much as anything. Your IP is owned and you've got the right sort of employment contracts in place. So we often start with legal, and it's not until a year or two down the line when you're raising larger sums or potentially even being acquired at that point that some of the more strategic services come into play. Although we spend a lot of time in the market, in the investment market, and therefore our team are very used to just giving introductions and suggestions about how you build a business plan, how you build an investment deck, and indeed making some introductions as well. So it's more of an execution plus service we describe at your stage, rather than simply going to a law firm to get the legal matters done. It's that sort of service as well as the some value adds.
Okay.
We'd like to have a conversation with you about that, though.
Yeah. Okay. Will do.
Yeah, just to add, happy to join the dots after the call. Thanks very much, John. Thank you. Just to wrap up then, if there's no more questions, just to add, if you do think of anything prior to coming off of the webinar, then do not hesitate to reach out and I can help to link you to the right people at EY. And I'd also like to say thank you very much to partners EY for delivering the seminar today. And the plan is that now that I have the go ahead, I will share slides, and I should have highlighted at the beginning, we are recording as well. So the aim is that perhaps if some attendees weren't able to log on, they can view the recording as well. So if there isn't any more comments or questions, then Greg and Rich, are you happy for me to close the session? Was that all, or was there anything else you wanted
No,
to?
that's great. Thank you
Yeah,
all.
no, that's great. Thanks very much. Thanks everyone for joining. Great to speak with you.
Brilliant stuff. Thanks all, and have a good rest of the day. Thank you.